Hey everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account and today's market updates. The market is not in a panic, and let's talk about the Federal Reserve's our predictions, the investors' prediction for the Federal Reserve's monetary policy decision for December. This week, the Fed posted its decision in November of keeping interest rate unchanged at 5.25% to 5.5% federal funds rate. It was once again a turning point for the U.S. stocks, with 3 U.S. major indexes took just half a week to recover losses from the previous 2 weeks. Expectations that the Fed will end its tightening are rising after several economic data began to weaken. The VIX, the fear index, fell 25% in the week as volatility as yields fell and risk appetite returned. In the coming weeks, the outside world will continue to watch the Federal Reserve's latest statement and economic data. Whether the U.S. Treasury can continue the adjustment will become the key to determine the rebound phase. Unlike the past few weeks, multiple data released last week shows that the tough U.S. economy appeared to crack, and after talking about the weak labor market, there was also a unexpected wage growth that fell to 4.1% in October. Unit labor costs fell 0.8% in the third quarter, the first decline since the first quarter of the fourth quarter last year, according to the Labor Department data. At the same time, services sector has experienced an expansion, and Atlanta Fed's GDP now in this week revised down its U.S. fourth quarter growth forecast to sharply 1.2% from 2.3% previously. Oxford Research Institute said in an interview that an economist said that in an interview with the first financial journalist, the non-farm report provides evidence that the labor market conditions are softening, and this is often an important signal of an economic slowdown. The Fed stayed on fire for a second time last week. The FOMC is weighing between the slowing economy and curbing inflation without risking a recession. Fed Chairman Powell reiterated that he would be cautious on future interest rate policy in an uncertain environment, but he also did not deny a possibility of a future interest rate further increase if there are signs of stubborn inflation. He said that a series of interest rates has put downward pressure on inflation and growth, expecting the economy to slow in the coming months and help further reduce inflation. Given the Fed's continued emphasis on data dependence, the November Fed decision appeared to be the beginning of a new phase of policy stance, given a new trend of reversal in economic data. The change in the market mentality, followed by the reversal of the surging U.S. bond market. The long-term Treasury yields will post their biggest weekly drop since 2020 March and November, respectively, with the 2-year note falling 4.83%, down 25 basis points in the past week, equivalent to a room for a rate hike, and the 10-year note fell to 4.56%, down 29 basis points, the biggest drop since the regional banking crisis this year. The federal funds future shows the probability that the Fed will hold interest rate unchanged in December to rise about 90%, with the first cut moving from June to May. The economist Schwartz believes that at the end of the rate hike does not mean a policy reversal is near, and the threshold for a rate cut remains high. The Fed needs to see slower growth, a more significant in signals for slower growth in the U.S. economy, and a further softening in labor conditions to be confident that the inflation is moving back to 2% sustainably, which could not emerge as early as the second half of the year. So the high interest rate conditions will likely to maintain for a long period of time before the Fed begins to change its monetary policy directions. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.